when talking about taxes, we'll use the term tax. Got to account for tax, got to pay tax, but often without really understanding the different types of taxes or exactly what tax bill you mean. You can be very guilty of just paying a tax bill without kind of really understanding what it's for, or just looking at tax as just this one lump sum amount that you've got to pay. What's up, guys? This is JP here, back with another episode of the Build Smart Blueprint. So in today's episode, I want to talk about taxes. This is a subject that, even from my own personal experience, is often overlooked in terms of a kind of subject for the accountant, subject for somebody else, especially when you're so busy just trying to build, get clients, deal with issues on site and stuff like that. Just when I often look back at my own experiences, but also speaking to clients, often when talking about taxes, we'll use the term tax. Got to account for tax, got to pay tax, but often without really understanding the different types of taxes or exactly what tax bill you mean. You can be very guilty of just paying a tax bill without kind of really understanding what it's for, or just looking at tax as just this one lump sum amount that you've got to pay. And I think that's fair enough in a way. Often you just really care about what money is in your pocket at the end of the day, after getting the work and paying all these bills. But I thought today it would be useful basically to break down some of those tax payments into different chunks. Some of them you may be aware of. Hopefully you're aware of all of them. But I'll try and go into a little bit of detail with each one about how it's calculated, when it's paid, and things like that, and obviously how it relates to the industry and building work. So just a little bit of a disclaimer: I'm not an accountant by any means, so I may be off with some of the specific numbers. Obviously, you want to get proper advice from your tax accountant or your accountant bookkeeper if you actually want to get specifics on your particular business, as some of these items might not be relevant, and also you might actually have additional taxes that you're paying, depending on how your business is set up, or your whatever your arrangement is. So without further ado, let's get straight into it. The first one is VAT. So this is probably the most commonly heard one, discussed one, probably the best understood one. So VAT is really only something that becomes relevant in your business once you start turning over £85,000 in the UK. So once that threshold is met, then you're going to become a VAT registered business. So what that means is essentially you've got to charge 20% on top of whatever your kind of costs are. So if you're billing the client, £5,000, you need to put 5,000 plus VAT, or actually put what's that on the spot there, 5.5 grand, including VAT on the actual bill that you're paying. So essentially VAT is a tax on goods and services in the UK. Any materials that you're actually buying are going to have VAT already added onto them. So that 20% is already added, and you will see that even when you're buying stuff for yourself. But the area where I find it sometimes becomes tricky or not fully understood is a lot of the contractors that you might be paying, or some of them might not be VAT registered because they're not over that £85,000 threshold. So it means that you are not paying the VAT when you're paying them, but because the client is paying you and you're then paying them, you have to charge that VAT. So you need to be careful, especially if you're kind of at the early stages of your business. If you're getting up to the VAT threshold, or going to be hitting it fairly soon, then you want to make sure that you're accounting for that additional 20% before it actually comes. Otherwise, you can kind of get a little bit caught out by kind of essentially underpricing your jobs. So the VAT items, or the VAT payment, the 20%, is paid usually on a quarterly basis, but you also can pay it on a monthly basis. Typically, for most companies, you will have a bookkeeper that will calculate how much your VAT bill is at the the end of the quarter or the end of the month. But it's actually not so complicated that you can't do it yourself. And a little bit of a plug, if you need some help with that, you can contact our company, Dynamic Assist, if you want a little bit of help in kind of learning how to do that yourself. But essentially, it's not as simple as just looking at 20% of how much money comes in for you as a business and you pay that to the government, because you can actually offset any VAT that you've paid for materials that you've already bought, or suppliers that are VAT registered. So essentially what the accountant or bookkeeper or you yourself are doing is you're calculating how much money came into your business. You're also calculating how much 20% VAT you paid, or 5%, whatever it is, on all the other materials and bits you bought, and you basically offset the difference, and then whatever is left is what you're paying at the end of the month. End of the month, or the end of the quarter. So my suggestion here, if you are dealing with VAT, because it's one that I think really guys trip over because they don't fully allocate for it, and it's always like a kind of unknown bill, is try and actually allocate 20% of the revenue that comes into your business and just put it away, and get into the mindset that that is your money. That's just money that you're just holding for the government, essentially. And really, actually, with any of these taxes, just look at it like that. It's not actually your money. It's always going to come into your business and then just go straight back out. So once you get comfortable with how much of these amounts each of them are, you can actually start kind of already pre-allocating the money once it comes in, putting it in aside from the actual kind of working capital that you've got in your business, so these kind of tax bills don't come as a surprise to you. So the next one is business rates. So business rates may not be applicable to a lot of companies. It's really only applicable if you've got a premises. So essentially, if you have got a premises, then you are going to have to pay an additional tax for having a premises, and this tax is calculated based on like the rentable value of the what's it called? Rentable value of the place that you're actually keeping. Again, most of the guys, if you're working kind of just from your van, working from home, everybody's working virtually, then you're not going to have to worry about this. But if you are actually have a premises, then this bill is going to come out monthly or annually. And similar to the VAT, it's going to be something that's going to be almost a fixed amount that you know that's going to come in. So you just want to put that aside, however frequently you pay it. So the next one is the corporation tax. So this one is a tax that pretty much everyone is going to be paying when you've got set up as a company, and this is a tax on basically the profits that you make in the business. The tax in itself is 19% at this current time of recording, and that tax is calculated once you deduct all of your allowable business expenses on the business. So once you as a business are declaring a certain amount of profit, 19% of that profit will then be paid as corporation tax to the HMRC in this case. So this is a tax. So I think sometimes this gets confused with the next one that I'm going to talk about, which is your kind of personal income tax. That is different because the corporation tax, think of it as the tax that the business is paying for the profit that it's making. And the next one is the income tax, which is the tax that you as an individual are paying for the money that you are earning as an individual out of the business. So it's a slightly kind of different way to look at it. Going back to the corporation tax, just before I get into the personal income tax, is that the corporation tax is going to be paid annually. It's usually due about 9 months from the point that your accounting period ends. The reason it's tied to your accounting period is obviously your accountant needs to work out what the total profit was, and then based on that, basically going to take that 19%, and that's what you're going to be paying. So going on to the next one is personal income tax. So you should be extracting some form of income from your business. So that could be your payment as like a dividend, or you could be taking a salary from the business as like a PAYE on essentially payroll on your own company. This tax, the amount of this tax really does vary on how much income you as an individual are getting. So not just looking at how much you're getting through your own business, but you might have some property, you might have another business where you're getting money in. So it's basically on a bracketed system. Going to range from like 20 to 40%. So I'd imagine most people listening to this are going to be on that higher tax bracket. But obviously you want to speak to your accountant that will be able to tell you exactly how much you're going to be paying. The tax in itself is usually going to be paid on a yearly basis. And that's when you do your self-assessment, or your accountant does your self-assessment, or you might be, if you're a PAYE, you might be paying that tax monthly as when like your salary comes in. Again, this is different, just to be clear, this is different from your corporation tax bill, but again, your accountant is the one that's usually going to be calculating what tax is due for yourself. And I think that's the reason why it sometimes gets confused with the corporation tax bill, because it kind of all come out at the same time, and it's all calculated at the same time often. Now, the last one that I just want to talk about is similar to your personal income tax, which is your national insurance contributions. Really, you probably could group them together in the sense of, like, think of this personal national insurance contribution as another tax that you're paying out of your own income. The slight difference is that the national insurance contribution is supposed to be kind of paying towards state pensions, healthcare insurance, that kind of thing, benefits and stuff like that. Whereas your personal income tax contribution is generally for just general government funding, essentially. Again, the national insurance contributions are priced charged differently depending on what bracket, but I think it's around 10-20%, something like that. But again, your accountant's going to be the one that's going to be calculating that, and that's basically going to be paid at the same time as your personal income tax. So either you're going to be doing it annually with your self-assessment, or on a monthly basis as you take money out via PAYE. So hopefully that kind of breaks some stuff down for you, to help you kind of understand where all of the different numbers are. If you're listening in a different country, obviously these might be slightly different, but most countries, the concepts are the same in terms of having your business paying a tax, and then you as an individual paying tax, and then often there's going to be a tax on the revenue like VAT. Also, just bear in mind that this is at the current time of recording, so exact tax rates do change, different criterias and stuff like that. So it's always going to be slightly different, but as I said, hopefully it's useful.